When you think about the AI revolution, your mind probably goes straight to software.
Yeah, totally. Like you picture vast neural networks or generative models writing code or, just a sleek chat app on your phone.
Exactly.
Yeah.
But the reality is actually far more industrial than that. I mean, the cloud doesn't literally live in the sky. It lives on the ground.
Right. It requires an insane amount of physical metal, complex thermal wiring, massive factory floors.
Yeah, and really hyper-specialized supply chains. And historically, all of that heavy, unglamorous lifting has basically been done by these legacy manufacturing companies just, humming along quietly in the background.
Well, because it's the physical ceiling on how fast digital innovation can actually grow. I mean, you can write the most advanced AI model in the world, but if you don't have the physical server racks built and tested and deployed at scale, that code literally has nowhere to live.
Right, which brings us to a fascinating case study for today. So welcome to today's Deep Dive. We are exploring Sanmina Corporation.
Yeah, specifically looking at their Q2 2026 financial results.
Right, pulling the data directly from their Form 10Q and their April 27th earnings press release. So for you listening, this is a mature, decades-old manufacturing business that essentially woke up one morning and decided to completely alter its DNA.
Yeah, they really did.
And our mission today is to decode how Sanmina's massive, $1.6 billion bet on AI infrastructure is radically transforming their business. We're going to look at the actual mechanics of that hypergrowth, and more importantly, we want to examine the hidden financial and operational costs that are, required to sustain it.
Because, a pivot of this magnitude is never just a simple plug-and-play scenario. When a legacy hardware manufacturer attempts to capture the absolute highest end of the AI market, they are fundamentally changing their risk profile.
Oh, absolutely.
Their balance sheet, their operational cadence, all it changes.
So if you're tracking global AI supply chains, or maybe you're looking to understand the mechanics of massive corporate mergers, or you just want to figure out where the money is actually flowing in this whole AI boom, we're going to bypass the dense accounting jargon and just get straight to the underlying mechanisms.
Sounds good.
And we really have to start with the top-line numbers for Q2 2026, because honestly, they represent a structural shift that demands an immediate explanation.
Yeah, the raw figures are, well, they're quite a departure from standard organic manufacturing growth. You almost never see this kind of velocity in physical supply chains.
No, you don't. So let's put the numbers on the table. Sanmina's Q2 2026 revenue hit $4.01 billion.
Wow.
Right? That is a 102.3% increase from the exact same quarter last year. They effectively doubled their top line. But the real story, the crazy part, is in their communications networks and cloud and AI infrastructure segment.
Yeah, that specific division exploded.
Yeah, up by 278.1% year over year to reach $2.77 billion.
And just to contextualize that for a second, this single segment is now generating significantly more revenue than the entire company was bringing in just 12 months ago.
Which is wild, because we know a legacy hardware manufacturer doesn't just achieve almost 300% growth in a division by, optimizing their sales funnel.
Right. Definitely not organically.
No. The catalyst here is clearly their October 2025 acquisition of ZT Systems. Sanmina bought them for $1.62 billion. And that was a mix of cash and stock.
Yeah.
And ZT Systems alone brought in $1.9 billion in revenue just in the second quarter. But let's look at the why. Why ZT Systems?
What's fascinating here is the specific mechanical role ZT Systems plays in the broader ecosystem. Sanmina didn't just buy a competitor to add standard manufacturing capacity.
Okay.
They bought a very specific capability called New Product Introduction, or NPI, for hyperscale computing. So by acquiring ZT Systems, Sanmina cemented a strategic relationship that basically makes them a premier U.S.-based NPI manufacturing partner for AMD's AI rack and cluster scale systems.
Okay, let's unpack this mechanism for a second. Because new product introduction isn't just taking an AMD blueprint and assembling parts on a conveyor belt, right?
Oh, no, exactly the opposite.
Yeah.
In the AI server space, the thermal management, the power distribution, the sheer physical density of the chips, they are so complex that the manufacturing process has to be co-engineered right alongside the silicon design.
So they're literally figuring out how to build it while it's being designed.
Exactly. NPI means ZT Systems is working directly with AMD engineers to figure out how to physically build these massive AI clusters at scale without them melting down or failing. Hyperscalers, companies like Microsoft, Google, Amazon, they don't just buy chips anymore.
Right.
They buy fully integrated, tested cluster scale racks. So Sanmina, via ZT, is now the crucial bottleneck provider making that physical integration happen.
Okay, I want to introduce an analogy here because the shift in their business model is profound. This isn't like a company that makes generic car parts suddenly deciding to build, I don't know, slightly faster engines. It's more like that generic car parts manufacturer just bought the entire engineering team that builds race cars for a top Formula One team.
Well, that's a perfect way to look at it.
Right. Like, they didn't just grow organically. They basically bought their way into the absolute highest tier of the race.
Mm-hmm.
But it creates this immense shock to the system because you're going from lower margin, highly predictable electronics manufacturing right into the absolute red line territory of the AI arms race.
Yeah, that F1 analogy holds up really well, especially when you look at the operational strain. I mean, the hyperscalers are in an absolute sprint right now. Sanmina's CEO, Girosola, explicitly noted that ZT Systems' customer demand was so aggressive that shipments they originally modeled for the second half of the year, they actually had to be pulled forward into Q2.
Which, I mean, that sounds fantastic on an earnings call, right? Like, everyone loves faster revenue. But mechanically, pulling demand forward is a logistical nightmare. You are expediting raw materials, you're running factory floors on crazy overtime, and you're really stressing your working capital.
Precisely. If you are building AI clusters as fast as you can physically source the components and ship them, you are operating with zero buffer. Your supply chain is just stretched, completely taut.
And that leads us to the reality of the balance sheet. Because, buying an F1 team and running it at Redline requires immense capital.
It definitely does.
So let's pivot from the shiny top-line AI revenue to the heavy cost of this transformation. Because Sanmina didn't just have $1.6 billion sitting around in a checking account to buy ZT Systems.
No, they had to finance this heavily. To execute the acquisition, Sanmina secured a massive new $3.5 billion credit facility. And as of this Q2 report, they have $2.2 billion currently drawn down under their term loans A and B.
Wait, $2.2 billion in new debt? I mean, in today's interest rate environment, that is a massive structural change for a legacy company.
Oh, it's huge. And you see the drag of that debt immediately. Their interest expense jumped from just $5 million a year ago to $32 million in this quarter alone.
Wow.
But, the debt load isn't the only financial anchor here. We really need to look at the mechanics of the earnout, or what the 10Q calls contingent consideration.
Oh, right.
This is a very common tool in massive acquisitions, particularly when you're buying a hyper-growth tech asset. The sellers of ZT Systems didn't just walk away with the initial purchase price. The deal was structured so that they can earn up to $450 million in additional payouts based on specific financial targets being met post-acquisition.
Yeah, and I actually found the accounting treatment of this earnout so fascinating in the filings. Because when a company structures an earnout, they had to estimate its fair value and record it as a liability on the balance sheet, right? But in Q2, Sanmina had to increase this earnout liability by $59 million. And the reason why is, well, it's entirely counterintuitive if you're not deep into M&A accounting. They took a $59 million expense hit precisely because ZT Systems is actually performing better than originally forecasted.
It is the classic double-edged sword of contingent consideration. I mean, if the acquired company struggles, your earnout liability shrinks, which looks great as an expense reduction on the income statement, but it actually means your acquisition is failing.
Right.
But here, because ZT Systems is crushing its targets and pulling those shipments forward, Sanmina's accounting team has to recognize that they are highly likely to pay out a lot more of that $450 million maximum. So paradoxically, their expenses increase because the underlying asset is succeeding.
It's just wild to think about. But let's look at the flip side of that success, because I want to push back on the whole profitability narrative for a second. So Sanmina just doubled its revenue. They are now the bottleneck provider for high-end, incredibly complex AI infrastructure for AMD. You would assume that operating at the top tier of the tech food chain gives you immense pricing power.
You would think so, yeah.
Yet, Sanmina's overall gross margin actually decreased slightly. It went from 8.9% a year ago to 8.8% this quarter. If you are building the most advanced AI servers on the planet, how are your margins compressing?
Well, that is where the whole F1 integration analogy comes into play. When you buy that massive new team and try to merge it with your legacy systems, there's massive friction. The margin compression isn't necessarily a reflection of the unit economics of the AI servers themselves. It is a reflection of the friction of the merger.
Oh, interesting.
Yeah, Sanmina actually incurred $73 million in acquisition and integration costs this quarter alone.
Wait, 73 million? Just for integration.
Exactly.
So that's going toward what? Like combining IT systems, restructuring the supply chain logistics, legal fees, trying to align two entirely different corporate cultures.
Precisely. And when you layer that $73 million of operational friction on top of the $32 million in debt interest, it heavily masks the underlying profitability of the actual products. I mean, they are squarely in the messy middle of the integration. You really won't see the true margin profile of the combined AI-driven Sanmina until these temporary integration costs fall away and the debt is managed down to, a steady state.
Okay, which brings up a really crucial debate about how management is actually allocating capital right now. Because despite the massive debt load and the margin compression from all that integration, the actual underlying cash engine of this company is roaring.
Oh, it's generating a ton of cash.
Yeah, in their press release, they reported $399 million in operating cash flow for the quarter and $342 million in free cash flow. They ended Q2 sitting on $1.58 billion in cash and cash equivalents.
And that level of cash generation is exactly why they were able to secure the $3.5 billion credit facility in the first place. Banks look at that cash conversion cycle, and they understand that the leverage is supported by incoming liquidity.
But here's where it gets really interesting. Because management strategy gets super aggressive here. They just exhausted their previous stock buyback program. They repurchased 1.1 million shares for $160 million in Q2.
Right.
And immediately, the board authorized a brand new, massive $600 million share repurchase program. I mean, I have to challenge the logic there. They are holding $2.2 billion in term loans. They're paying $32 million a quarter just to service that debt, while simultaneously pushing $600 million out the door to buy their own stock. From a purely capital allocation standpoint, I mean, that borders on risky financial engineering, doesn't it? Why not just deleverage the balance sheet?
It's a very valid critique, and it really comes down to cost of capital and, more importantly, signaling. If you look closely at the earnings commentary, CFO John Faust explicitly stated they are focused on returning capital to shareholders while, and I quote, maintaining our leverage within our target range.
Okay, so meaning they aren't actually looking to be debt-free.
Not at all.
They're comfortable carrying a few billion in debt as a permanent feature of their capital structure now that they're this much larger.
Precisely. They have basically modeled out their future cash flows and determined that their return on invested capital from shrinking the equity base, buying back shares, is higher than the benefit of paying down the term loans. But beyond the math, it is a massive signal to Wall Street.
How so?
By initiating a $600 million buyback while holding heavy debt, management is essentially screaming to the market that they view the massive cash generation from the AMD and ZT Systems deal as highly sustainable. It's permanent.
Ah, I see.
If they feared the AI hardware boom was just a temporary bubble that might pop next year, they would be hoarding every single cent of that free cash flow to pay down the loan. So the buyback is really the ultimate display of confidence in the longevity of hyperscale demand.
Okay, I see where you're going, but it is definitely a high-wire act. They are fully leaning into this new identity. But, it's really easy to get blinded by the massive cash flows and the AI rockets and the stock buybacks. When you dig beneath the press release and actually read the footnotes of the 10Q, which, let's be honest, is where the unvarnished reality of any company lives, you find this trail of legal and regulatory hurdles.
Yeah, the footnotes are always a sober reminder that a company is really just an aggregation of historical decisions. You don't get to shed your past liabilities just because you acquired a shiny new AI division.
Exactly. Because scaling a physical manufacturing footprint globally creates this immense surface area for risk. So let's look under the hood at 3 specific threats detailed in the 10Q that really show the cost of being a legacy manufacturer. First, we have an ongoing wave of California labor lawsuits.
Right.
The filings list multiple class action and PAGS lawsuits that stands for Private Attorneys General Act. So we have former employees like Ramirez, Lubados, Gomez, Guerrero, and Buezo, and they're alleging wage, overtime, and meal period violations that date all the way back to 2020.
And PAGA lawsuits are a very distinct mechanism in California labor law. They basically allow aggrieved employees to step into the shoes of the state labor commissioner and sue for civil penalties on behalf of themselves and other employees.
Wow.
Yeah, and for a manufacturer operating massive factory floors in California, these suits are incredibly difficult to dismiss early.
And while, one PAGI suit might be manageable, When they stack up alongside multiple class actions, the legal defense costs, and just the administrative burden of discovery, it becomes a really heavy, persistent drain on the company's focus and resources. I mean, it is the friction cost of operating human-intensive supply chains.
Which is a sharp contrast to, say, a pure software AI company that might just have a few hundred engineers sitting in an office.
Right.
Sanmina manages tens of thousands of factory workers. The liability profile is completely different.
And that physical footprint risk gets even more intense when you look at their defense contracts. Because the second major threat in the footnotes is the Eckert Tam suit.
Yes.
This is a whistleblower lawsuit targeting Sanmina's SCI defense subsidiary. The allegation is a massive $100 million government fraud case under the False Claims Act. The claims specifically allege issues like false cost pricing and underpaying employees.
And the mechanics of a False Claims Act suit are severe. A quid tam provision allows a private citizen, the whistleblower, to essentially file a lawsuit on behalf of the U.S. government alleging fraud against federal programs. And if they're successful, the damages can actually be tripled.
Tripled? Wow. Now, the sources do note that the Department of Justice declined to intervene in the case, at least for now.
Yeah.
But that doesn't mean the threat just evaporates.
No, not all.
The whistleblower is actively proceeding with the suit.
Yep.
And even if you believe you are entirely innocent, defending against a complex $100 million False Claims Act case regarding aerospace and defense pricing requires an absolute army of lawyers.
It really does. It's a massive distraction for a management team that is supposedly focusing on integrating an AI hypergrowth asset. It creates this bifurcated focus. The executive team has to look forward to the AMD hyperscale future while constantly paying legal retainers to litigate past defense contracting procedures.
Which brings me to the third and perhaps most illustrative example of this legacy drag. It's what we can call the ghost of 2009.
Ah, yes.
According to the 10Q, Sanmina is currently fighting an IRS audit that is actively disputing a $503 million worthless stock deduction from fiscal year 2009. The IRS is asserting an $8 million underpayment for 2009 alone, and the filing warns that this adjustment could cascade into later years. But wait, 2009? I mean, that's the era of flip phones and the global financial crisis.
Yeah, exactly. It's wild. The mechanism of a worthless stock deduction is critical here, though. When a company determines that a subsidiary or an equity investment has lost all of its value, they can sometimes write that off to offset taxable income. But a $503 million deduction is monumental. The IRS does not let half-billion-dollar deductions go without intense, prolonged scrutiny.
It really highlights how long the tail of corporate liability extends. I mean, you have management deeply focused on how to build thermal liquid cooling for 2026 AI clusters, and simultaneously their tax team is sitting in some tribunal arguing about asset valuations from almost 2 decades ago.
Well, if we connect this to the bigger picture, it totally recontextualizes that $1.58 billion in cash they're holding. I mean, yes, the cash flow supports the $2.2 billion in new debt. Yes, it funds the aggressive $600 million stock buyback. But strategically, a massive cash reserve acts as vital armor.
Right.
When you have a massive physical footprint, long-tail liabilities like Pegasus suits, False Claims Act litigation, and decade-old IRS audits, they never truly disappear. You need deep liquidity just to survive your own footnotes.
That is so true. It really requires an incredible balancing act. If you look at Sanmina from the outside, you have to weigh these two completely different realities. On one hand, they have executed a brilliant strategic maneuver.
Absolutely.
They recognize that the AI revolution requires specialized physical infrastructure. They bought ZT Systems to acquire that new product introduction capability, and they successfully hitched themselves to the massive engine of AMD and the hyperscalers.
Yeah, they doubled their revenue in a single year, and they are throwing off hundreds of millions in free cash flow.
But on the other hand, the cost of that evolution is incredibly steep. They're carrying a heavy, high-interest debt load. Their immediate gross margins are being suppressed by the massive friction of integration, and they are dragging decades of complex legal and tax liabilities behind them. Like, they've upgraded the F1 engine, but the chassis is still rattling from the sheer force of it.
Yeah, they're definitely managing the stress of that transformation.
And for you listening, the reason taking this deep dive matters is that it reframes how we view the broader technology landscape. The AI revolution isn't just about software or algorithms floating in the ether. It is deeply tethered to the physical world. It requires companies like Sanmina doing the heavy lifting in the background, building, testing, and shipping thousands of tons of metal and silicon.
Right, and as the demand from hyperscalers continues to pull those shipments forward and forces these manufacturers to run their factories at maximum capacity, it is reshaping the entire global supply chain.
Which leaves us with a final, provocative thought for you to chew on. As the AI hardware demands continue to completely dominate the revenue streams and operational focus of these legacy manufacturers, what happens to everyone else? I mean, if a traditional electronics manufacturer becomes entirely consumed by hyperscale infrastructure, dedicating all their premier factory space and engineering talent to AI, could this gold rush leave other crucial industries, like medical devices or commercial aerospace, scrambling for factory space and attention? As the digital future gets hungrier, it is literally eating the factory floor. Keep an eye on how these physical supply chains evolve.